Yeah, so the debt or the inventory on the balance sheet is expensed in the cost of goods sold on the income statement. That's the last link between the income statement and the balance sheet. Any questions so far? Now I think we're a smaller group, so happy to take any questions. You can also say that you didn't understand like anything, and I'm happy to go over everything again. Confused or understanding?
You started cutting out when you were beginning to talk about debt. So you added
Okay.
debt to non-current liabilities, and that's when I kind of lost you. I don't know if it was the
Okay.
same for other
Yeah.
people.
No problem. No problem. So the debt is a non-current liability on the balance sheet. So any interest expense on that debt that we have on the balance sheet is recognized here on the income statement in the interest expense. So that's the third link I think on the presentation that I shared. So all the debt that we have, any interest expense on that is recognized here on the income statement. And then the last point is inventory. So we have inventory under the current assets account on the balance sheet. And when we sell off any of that inventory, that goes under the cost of goods sold on the income statement. So if we had like 100 units here and we sold off 20 units from that, so those 20 units would go here and the net inventory would be 80 units or $80 if every unit is $1. So that,
Okay, so is COGS a cost or?
yeah, COGS is the cost of goods sold. So as I spoke in the last session, it's the direct cost for manufacturing. So it is basically the inventory cost and also any direct labor that is involved with the production of that product or service. So the people on the assembly line, basically.
So COGS is basically sold inventory.
Yeah, yeah.
Okay.
For the most part, yes, but also it includes any direct labor expenses, but not people in the back office though. Their salaries and their expenses go under the SG&A here. Any other questions? Okay, so next up we'll explore the links between the balance sheet and the cash flow statement.
Yeah. So inventory on assets on the balance sheet is, sorry.
Yeah, go ahead.
Sorry. No, my bad. I was cutting out. I didn't know you were talking.
Mhm.
So inventory on assets in the balance sheet is like the total stock of current inventory, right?
Yes.
And any changes that happen to that go into COGS.
Yes. And
Okay.
changes would be basically a decrease because you'll be selling that off.
Right.
And if you increase the inventory, that doesn't have to do anything with the cost of goods sold. It's just when you sell that inventory off. Okay. Is everyone with me? Any questions? Especially for people who didn't attend the last week's session, it might be a little more difficult to understand. So I'm happy to take any questions. I'll give you like 30 seconds to think if you have any questions, and just to take it all in and just have a breather. Okay, seeing no questions, I'll move on to the next subtopic, which is the balance sheet and cash flow statement. So in the cash flow statement, we have capex, which is a cash outflow. So any money that you spend on acquiring a factory or purchasing a factory or purchasing any equipment, that goes in the PP&E here. So the capex from the cash flows from investing activities goes here in the non-current assets on the balance sheet. So for example, if you spent $100 on buying a machine, so that $100 goes here and also here, and then in the PP&E.
Sorry, can you repeat? Can you repeat that?
Yeah. So the first link is that the capex from the cash flow from investing goes into the PP&E in non-current assets on the balance sheet. So if you spend $100 on purchasing some machinery or purchasing some factory or stuff, any physical capital, that expenditure is recognized here, and the asset that you acquire, so the machinery or the factory, that is recognized here. It's basically the same figure here and here. Okay.
So capex is a subtraction.
Capex is a net outflow, or is a cash outflow, yes.
Cash outflow.
Yes, yes. So I'll skip the working capital for now. We'll talk about this last because it'll require some more explanation. So the next thing is that the depreciation and amortization flows out from the PP&E schedule into the cash flow from operations. So remember, we start with net income. And that is basically this net income here. And now we're only looking at cash. So we have to add back any non-cash expenses. So we add DNA. We add DNA because the depreciation and amortization is a non-cash expense. But because we deducted it here in the income statement, we have to add it back here so that we actually get to the cash number. Because we recognize this as an expense here, and we said like we only made a profit of 50, but we can say like we actually made a profit of 60 because this DNA was not a cash expense. So in terms of cash, we actually made more.
We had 10 in depreciation.
Sorry.
Yeah. Okay.
Or you can have 200. So this is the same number here and here, but there in the income statement, it's an expense. We deduct that or we subtract that, and here we added that because it's non-cash. And on the cash flow statement, the only thing we're concerned with, or the only thing that we're looking at, is the cash outflow or the cash inflow. We don't care about the accrual accounting anymore on the cash flow statement. Okay, so the next thing is that any change in debt. So if you took on more debt, so if you took on 1,000, actually, here you'll have debt. So if in year one you had $1,000 of debt, and if in year two you have 50, or in at the beginning of the year you had $1,000 in debt, and at the end of the year you had $1,500 in debt, it basically tells you that you took on $500 more of that during that year, and that goes in the cash flow from financing. Because remember I said that where did that go? Oh, sorry. So remember I said that there's two ways to raise capital for a company, either through equity or debt. So if you took on more debt, and those both things are recognized under the cash flow from financing. So if you took on more debt, which is 500, that's also reflected on the balance sheet, because the beginning balance sheet would only have a debt of $1,000, but the ending balance sheet or the closing balance sheet for that year would have a debt of $1,500 because you took on 500 more. And then the last thing is the total cash flow is cash flow from operations plus cash flow from investing plus cash flow from financing. So that's the total cash flow for that year. And then you'd get the opening cash flow from the balance sheet. From the opening balance sheet. and then the ending cash flow is the two above. So if you generated 500 or $1,000 during that year, and the opening cash flow for that year was $2,000, you just add that together to get the $3,000. And this $3,000, and this would become the closing cash balance on the balance sheet. Remember, I said there's two balance sheets for a financial period because it's a snapshot and not really over a period of time. So you have the opening balance sheet and then the closing balance sheet. So if at the beginning of the year you had $1,000 on the opening balance sheet, and during that year you generated 2,000 more. So on the closing or the ending balance sheet, you'll have a total of $3,000. 1,000 that you started with and 2,000 more that you generated during that year. So this is how it works. And between the income statement and the cash flow statement, so the first link is what I said here. Net income from the income statement is the first line on the cash flow from operations. And then we add back any non-cash expenses, and that gives you the cash flow from operations. And then again, something that I talked about earlier as well, D&A or depreciation and amortization is an expense on the income statement, but it is added back on the cash flow statement because it is a non-cash expense. So the distinction between cash expenses and non-cash expenses is really critical here. Okay, so we covered all the linkages except the working capital, but I want to stop here and see if there's any questions. Just anything at all, don't hesitate to ask. And you can just unmute yourself.
Yeah, just to recall, so what would our final statement for ending cash flow be?
So the ending cash would be the opening cash flow that you'll get from the balance sheet.
Right.
And you'll add the cash flow that you generated during that year, which is the sum of cash flow from operations, investing, and financing. And then that'll give you the ending cash flow. And that ending cash flow would go on the closing or the ending balance sheet.
And the opening cash flow is basically what we had from last period.
Yes, exactly.
Oh, the opening cash flow. Oh, okay, it's from the balance.
Hey guys, I don't know why my internet keeps being spotty. So you guys can hop off and we'll start it from here next week. So we'll go over how the working capital is taken into account and how, and then we'll talk about the annual reports and how to actually read them, understand them. Again, I'm so sorry. I don't know why this keeps happening, but I'll make sure not that this won't happen next week. And also we're at time, so.
Thank you.
No worries, thank you. Happens to all of us.
Yeah, so for next week, I'd appreciate if you could watch the first session's recording again, or if you like from whatever source that you want to use. Let's go over like how to construct an income statement, how to construct a balance sheet, and how to construct a cash flow statement. You should have all the line items for all these statements just on your fingertips. So if I ask you like where can you find depreciation and amortization, you could be confident enough to say like it comes from the balance sheet, from the PP&E schedule. It's an expense on the income statement, and it's added back on the cash flow statement under the cash flow from operations. So you should be like this quick with actually, knowing where everything is on the three financial statements, because the linkages would not make sense unless you actually know like where everything is on the financial statements. Because sometimes the links are just, a common element that many financial statements have. So again, for example, depreciation and amortization is a common element in the income statement and the cash flow statement, but you would not recognize it as a common element unless you actually know what the elements of the income statement are. or what the elements of the cash flow statement are. So for next week, we'll talk about working capital because that's something really important, especially for interviews. So I'll be spending a little more time on that. And during the week, I would not be going over 3 financial statements again next week because I'd expect you all to do some homework this week to actually get a good grasp of the financial statements, because everything we learn from here on, the financial ratios or the valuation method, so comparables, precedent, transaction, and DCF, everything builds on these financial statements. So unless you have a good enough understanding of what the financial statements are and where everything is on the financial statement and what the line items mean, and what's each line item significance, you would not be able to actually understand how the valuation methods work. So I know everyone is looking forward to actually building a DCF, but for that you actually need to know how the financial statements work. So this week I'm happy to maybe organize like another session during the week if any one of you has any questions, but I'm always available. Like you can just text me or just email me if you have any questions, and we can schedule 15-20 minutes. It's no worries during the week as well. Happy to help in any way I can, so feel free to make use of me as a resource before I graduate. And I'm, again, like, disclaimer, I'm not an expert, but I've studied this stuff, and maybe I know a little more at this point, so I'm happy to share with everything that I know with you all. So with that, we'll end today's session. Again, I apologize for the internet issues. And next week, we'll talk about working capital, financial ratios, and we'll maybe start looking at how valuation works. Okay, are you guys interested in bonds at all? Like how bonds work? I'm thinking, so the way I'm thinking right now is we'll talk about the valuation methods, and then we'll talk, after all that is done, maybe we can talk about bonds or options or futures or swaps, because bonds is a debt instrument, and then all those futures, options, and everything is derivatives. And then there's also alternative investments. So I know all of you have like heard these terms at least once during the info sessions that you guys attend. But to most of you, like to me, it didn't make sense when I was, last year, it didn't make sense to me at all. So I know everyone is like kind of curious to know what actually all of this is. And also if you're applying to, a capital markets job or more of like a market facing job, it's important to understand what options are or what derivatives are. Because many people would say like I work on the derivatives desk, and during a networking call you wouldn't understand like what that actually means. So I'll be covering that kind of towards the end of the semester, because it's not really relevant to what we do in the investment group, because we never talk about anything except equities. But I'm happy to go over it as much as I know about it. So that's the plan for the semester. Any questions, you can reach out. I know we're over by 6 minutes, so you can just reach out with any questions. I'll drop my number here again. So my email is, and my number is, and I'm very casual on text, so you can just like text me. It's no worries. Don't like think of phrasing it the perfect way. You could just be like, yo, like tell me this. I'll be happy. Okay, perfect. So see you guys next week. And this video would be posted on YouTube, so you can go over it again. Awesome. See you guys next week. Have a good rest of the weekend, and good luck with midterms. Okay, bye.
Thank you. Bye.
Thank you.
Thank you.
No problem.